And what do you make of the numbers? They are way stronger than expected, perhaps justifying that the PBOC stood pat when it came to the MLF.
Yeah, that's a good point. I'm afraid that the set of data, overall speaking, IP, retail sales, fixed asset investment, all beat our and also market expectation by a very wide margin. I'm afraid that we need to look at the details to understand how that all these growth momentum suddenly just jumped up out of nowhere. But I would say that if this is showing that not only properties but also infrastructure, for example, within investment, are all doing so much better than compared to fourth quarter last year, then there is a potential hope for the growth stabilization that we were hoping for. But that said, I'm afraid that the Jan and Feb data are still being very much affected by the high base from last year. So the hurdle for the numbers to be this high is extremely high. So I'm even myself a little bit puzzled to see that all across the board that activity growth indicators are so strong. I'm afraid that that indicates probably both exports as well as domestic demand seems to have done better, much better than people originally expected. And that also explains, for example, why the central bank has been
Helen, you do wonder whether those strong numbers are sustainable, especially now that we're seeing that lockdown in Shenzhen and high energy costs for China.
That's correct. I'm afraid that the recent lockdown measures in Shenzhen, as well as Dongguan, in the largest provincial economy of Guangdong in China, is potentially weighing on the export growth as well as the overall consumption growth. And we probably are going to see a little bit of a spread out from there to other places as well. So as we speak, for example, Jilin province is under lockdown, and Shanghai is in selective lockdown at the moment. But given that the number of COVID cases have surged so quickly in the past 7 days or so, I'm afraid that the risk is tilting to the upside for broader lockdown measures to be undertaken by more cities for longer.
Helen, it is interesting. You mentioned base effects. How do they play out here? And, we had the Lunar New Year included in some of these numbers too. So give us a sense of how they might be slightly more inflated than they would be normally.
Well, Jan and Feb combined would actually help reduce this particular seasonality problem from the Lunar New Year. So if I were to say that if we look at the data today for the 2 months, I wouldn't say that it's mostly because of the Lunar New Year effect, as the weeks before and after are all included. But that said, the base is actually quite high from last year, mainly because that last year in the first quarter growth was still fine. And because of the weak base from 2020, the reading in year-on-year terms was particularly high, and the sequential was strong. So as a result, we think that this year it will be harder for us to see a very strong number, especially before April. But definitely the numbers today all surprise on the upside.
So, Helen, give us an idea then whether you'd be, at the moment, reevaluating your growth forecast for this quarter, if so, by so much. Some out there have suggested that perhaps we would see very little or no, little or no growth for the first 3 months of the year.
Well, at the moment, our first quarter GDP growth forecast is 4.6% year on year. I would say that before I saw the numbers today, my worry is that the risks are probably skewing to the downside, given the very widespread COVID cases right now, the outbreak being larger than previous waves, and the lockdowns being more severe. But I think given the January and February numbers already in place, just released, this is suggesting that we probably will still have positive growth for, very likely for the first quarter. But whether that can be still well above 4%, we still need to wait and see some high frequency data.
Helen, what would it take for China to achieve its 5.5% growth target for the year? What kind of stimulus will be needed?
Well, I think for 5.5% growth, this would require a lot more efforts from both fiscal and also monetary easing. On the fiscal side, we are looking at the budget deficit number being pretty cautiously set at only 2.8%. But in our view, the NPC has actually, indicated more fiscal stimulus from other means, which is, by the broader definition of a fiscal deficit, what we call is a consolidated fiscal balance. We're actually seeing a deficit of going up to potentially 7.1%. This is much higher than last year's 4.4, and we think that they definitely need to do more from a fiscal perspective to stimulate growth. And in the near future, most likely the focus is still infrastructure investment. And in the meantime, we're expecting monetary easing to push forward as well. In addition to continued efforts to promote the credit expansion. And as we saw, the February number was quite disappointing. They definitely need to do more window guidance to motivate more lending. At the same time, we are also expecting rate cut and also reserve requirement ratio cut. This morning, I think the MLF rate keeping unchanged probably indicate that the PBOC is not in a hurry to do so. But we think the window of opportunity is probably, getting a little bit less, present as the Fed is about to hike very soon. So we're hoping that we can see the PBOC to play a catch-up game in the near future, and that will help ultimately to push the GDP growth above 5%. But to go to 5.5%, we think more measures, especially on the property side, needs to be introduced to support the current demand. Thank you.
Helen, very, very quickly, of course, the conflict in Ukraine is causing these inflationary expectations to ratchet up across the globe. How does higher inflation, food inflation and energy inflation, really at the moment play into the way you look at the Chinese economy?
Well, the high energy inflation at the moment is starting to hurt, especially through the fuel prices, as you said, Rich. But at the moment, I would say that, because of the NDRC's smoothing system, we probably wouldn't see that the retail price of gasoline going up for too much for too long. And also, we think that, however, for companies, the higher commodity prices are probably going to weigh on their margin and probably squeeze some of them out of business. So at the moment, we think that the impact is probably bigger on industrial activities than on household disposable income on their spending. But that said, I would say that there is definitely higher up risk on our current forecast of CPI inflation at 1.8% for the year. In terms of core, it is still very stable because overall aggregate demand is extremely weak. But in terms of the headline, we think that this would most likely go above 2%.